Hello everybody, Luke Gromen, FFTT. Hope you had a great weekend. This will be the final bi-weekly episode of 2022, so let's jump right in. First question from JM. What's to stop them from inflating away the debt, but only to 100 or 95% of GDP? Why is 75 or 80% the magic number? They could try to do that and stop there. My estimate of 75 to 80% was based on the level needed for the Fed to be able to normalize policy without quickly blowing things up, because that was a conservative estimate of the level of GDP, of debt to GDP, when the Fed last did so, and I would argue that was in the 90s. I say it's conservative because debt to GDP was more like 60 to 70% back then. So that is really the key driver, is what's the level of debt to GDP needed where the Fed can go back to normalizing without causing chaos pretty much immediately somewhere. And we've seen that's 2022. We've seen chaos pretty much everywhere but the dollar and energy and gold. Next question from NP. Everybody's looking for a Fed pivot. Maybe the global South actually pivots first, forcing the developed market nations to react to a new financial or geopolitical reality. If this is a non-zero possibility, how would one hedge against this? Dollar, cash, and treasuries might not be the best bet in that case. I agree, and I agree that it's a non-zero possibility. I think it ties into a little bit with what Zoltan Pozsar talked about with Russia and gold, selling oil for gold. The big theme around the world all year is the strong dollar's killing people. And also, they need energy. That is also killing people. So, metaphorically, so far, I would take Ghana as an example, where they talked about bartering gold for oil as a way of reducing their dollar energy needs. If we separate Ghana, we separate gold. Bigger picture, if you see more nations being able / willing to transact in multi-currency for energy and commodities, in particular the yuan, then that becomes a bit of a game changer over time for the global South. In terms of it reduces their need for energy, for dollars for energy dramatically, frees up their dollar liquidity, buys them time, and everyone, and myself included, has on the assumption or the bet outright that the U.S. will be the last to break due to the strong dollar. I don't know that the U.S. will be last. I don't think it's going to be first, though. Put it that way, given U.S. dollar debt for everyone involved. So if the global South were to move to a more multipolar commodity and in particular energy transactional system, that would be basically a pivot of note, economically and geopolitically worth noting. So let's see if that continues. A follow-on question from MN is, can you explain the Ghana oil for gold trade about which you spoke recently? So it was in the news a couple weeks ago. For an emerging market, you need dollars, principally for two reasons. Number one, if you have debt, it's generally dollar-denominated debt. And number two, you import energy. We'll leave some of the energy exporting emerging markets out of this discussion for the moment. So if you can reduce, you need dollars for both. If you can reduce your dollar demands for energy by transacting with an energy supplier in, for example, gold, then that frees up that dollar liquidity to be applied to the dollar debt. It improves your debt position, your liquidity position vis-a-vis your dollar obligations in any given year. Should support your currency as a result of that. Now, you would need to do this deal in most nations' cases at an above market gold to oil ratio, right? So if you look at the COMEX price of gold divided by the NYMEX price of oil, you get a ratio. You say that ratio is 25 today. If you do that deal at 30 barrels per ounce of gold with, say, a Russia, then all of a sudden, you as an emerging market could go short oil futures, take the dollars, go to the COMEX, buy the gold, take the gold to Russia, get 30 barrels of oil for that ounce of gold, come back, cover your oil short at 25 barrels at the COMEX-NYMEX rate, and you get 5 barrels of oil for free. Purely theoretical. But you can quickly see here, all of a sudden, this gives you the ability to continue growing your economy because you keep getting oil and improve your dollar liquidity, which would then free up to make your debt position, the servicing of your debt better. And that would improve your currency. So it's a very virtuous cycle. There will be, in theory, a lot of people interested in this. You need an energy exporter willing to sell outside the dollar. Obviously, we have one of those, and one of them in particular being nuclear-armed Russia. So that is the dynamic. That is the reason. Will it be successful? That's the theory. There's a whole lot of stuff between the theory and then the execution on the ground, particularly in Ghana's case, that may ultimately prevent that. But as we continue to see more of this gold for oil, gold for oil, gold for oil, we've been seeing it for 15 years with Russia reserving gold by increasing amounts. But now you're starting to see, Ghana talk about it, Zoltan Pozsar talk about it. There seems to be a perhaps multipolar energy getting, certainly the Saudi Xi meeting last week where it was talked about yuan, Saudi oil for yuan. There's building momentum to multi-currency energy, which would, as it gains momentum, amount to a pivot by the global south, if you will, to use NP's words. So let's see, next question. Jim, disaster looks baked in the math of public finances and markets, so why does my chart work show so many equities bottoming and some even entering new uptrends? Perhaps the inevitable recession will be delayed longer than seems possible. I think it probably depends on sector. Cost of capital has risen pretty meaningfully, and that's really bad for businesses that are dependent on free money. And it's generally good for, if for no other reason than a flows perspective, for industrials and cyclicals. And I think we're seeing that in the charts and in the relative outperformance of various sectors. I will say what I still think most, in my opinion, are missing. And what is completely different about this cycle versus any other cycle in the past 100 years in the West is that the risk-free asset underpinning every other asset on the board except gold and silver to a lesser extent, physical gold and silver, the risk-free asset is no longer risk-free if money is no longer free. So treasuries, and this is what I've talked about, where treasuries are the risk-free asset, but the U.S. government's debt and deficit position is so out of whack that they need free money just to keep the wheels on the cart. So if the risk-free asset is now risky, and we've seen that this year, treasuries, the TLT was down more than equities in a big drawdown for equities. And okay, early inflation, I get it. Inflation rolled off in the back half of the year sequentially, and treasuries sold off more as inflation rolled off, which I think was a very, very underappreciated important signal. But if the risk-free asset is now risky, on some level, all bets are off. And so to me, I expect the high volatility we've seen this year to continue. It might even get worse in 2023, unless the Fed comes in with more QE. And ultimately, this is why we hold cash, a very barbelled portfolio of cash, gold, industrials, energy-related commodities, and some Bitcoin. Let's see, OW, in what ways has your portfolio breakdown changed over the past couple of years, and what Fed decisions would have to be made for you to change it again? It's a good question. So I sold most of my Bitcoin, as I think I told everybody, and certainly told clients in June of 2021. I used those proceeds and paid off my house, and I figured worst case out of the whole Bitcoin position, I had my debt removed on my house. That's always a good thing. Regrettably, I bought Bitcoin back too soon in late 2021 and in the first half of 2022, but I think that position is going to work. I think it works very well over time. I think it's a very highly levered play or high beta way to play global sovereign debt bubble bursting. Stopped recommending big tech as a sector in late 21, early 2022 was another change. Significantly increased my cash holdings and recommendation of cash holdings from April 2022 on, and continue to do so. More recently, recommended buying some AAA rated corporate bonds yielding more than 5% in amounts up to any fixed rate mortgage you might have with a rate below 5%, basically making yourself a bank while the availability is there. And in terms of what it would take to change my stance is a much more explicit Fed shift back into explicit QE. That would be, in essence, to finance U.S. deficits and or prevent a global economic crisis at the sovereign level. Ultimately, I think they're going to have to do that if they don't want to stand aside and default on either Treasuries entitlements or massively slash the defense budget. The next question is from GW. Do you think that the U.S. goes back to the gold standard, or how do you think the U.S. transitions out of U.S. Treasuries as the reserve asset of the world? And realistically, could we even begin the transition without spooking the Treasury market? I don't think we're going back to a gold standard in the U.S. or anywhere in the world. I will say global central banks have begun the process of transitioning away from Treasuries toward gold over the last 9 years. Showed the chart before, $270 billion in gold buying, $300 billion or so of Treasury selling since 3Q14. I would say for the U.S. to support the move, if the U.S. wanted to support the move, I would say a very good first step, in my opinion, would be to indict the safety of Treasuries as an FX reserve asset, which occurred in February of 2022, earlier this year, when we sanctioned or froze Russian FX reserves. Everybody around the world holding Treasuries as a reserve asset took note of that, particularly some of the biggest players who might not always be in our good graces. Now, can we begin the transition without spooking the Treasury market? I think this slow-moving transition away from Treasuries, the fact that foreign central banks stopped buying Treasuries 8 years ago, is the slow-moving gear why we've begun seeing the Treasury market get intermittently spooked. Repo rate spike in September 2019. There were regulatory issues, there were cash flow issues. End of the day, big picture, that was an issue of too much Treasury supply, not enough demand. So we started to see a spook there. Then in March 2020, in the equity crash, all of a sudden off-the-run Treasuries, no liquidity, spook. Then again, earlier this year, I just talked about how Treasuries sold off more than equities, first time in 60 years in a top 20 drawdown in equities, based on data by Michael Gayed that we've shown you guys before. So, you started to see Treasury market liquidity and volatility get very critical again in September of this year. We've seen some time bought for that with the DXY, the US dollar index, go from 114 to 104. Paradoxically, lower dollar, given FX hedging costs, lower dollar lowers increases the FX hedged Treasury yield effective to foreign buyers, big foreign buyers. And so lower dollar is more foreign buying. So this move down in the dollar has helped the Treasury market a bit. We've seen that in lower Treasury yields with the lower dollar. Again, it's paradoxical, but it's the FX hedging costs really driving marginal flows. So I think the market's already spooked. So I think it's a slow motion. I think it's going to be another one of these slow motion trends, and then sort of all at once, some sort of big dynamic happens where at some point you're going to need gold to be made big enough to take leaps and bounds, right? 260 billion in gold that central banks have bought since 14. Who cares? Right, it's true. Who cares? Put a zero on the end of it. Suddenly you're talking about a lot of money, a recap of central bank balance sheets. That makes a lot of sense. So let's watch and see. But I think it's going to continue to be slow motion for the time being. From SN, what do you see for Europe in the next 5 to 10 years? It's a long time horizon. For me, as with all of us, the outlook for Europe depends on their choices. Choose poorly, and I think we're going to see a very weak currency in Europe and in the UK. I think places will become a tourist destination for Americans and Asians. You'll have tax havens within them around sort of the current financial centers of Europe and London. It'll be heavily deindustrialized for lack of energy, and with factories moving to the U.S. and to China and elsewhere in Southeast Asia. And that's, I think, what happens if they choose poorly around their energy policy. If they choose wisely, I think we'll see their global competitiveness rise. I think they'll see an ability to buy energy in their own currency. And I think they end up being one of the 3 major regional reserve currencies in a multipolar world alongside the dollar and the yuan, with very high standards of living. But if they fail to make the right choice on energy policy, which is buy energy in your own currency, even if you piss off the Americans, they're on track for the first option, which is a sustained decline in living standards, unfortunately. So, we'll see. It's been one of my big surprises this year is how short-sighted and how willing European leaders were to choose what is effectively economic suicide around energy policy to try to virtue signal. And that's not to play down what's happening in Russia and Ukraine at all. That is, it's a tragedy, etc. You don't fix a tragedy by killing yourself, though, and that's what Europe's doing. So I don't understand that. So on to the next question from LD. What is the Fed's move if something breaks that could spur systemic risk, but inflation has come down to just 4 to 5%? They're going to have to rescue it, I think. In my opinion, something big systemic breaking is the Treasury market again. We've talked about how they bought time. They, not so much the Fed, a little bit with the decline in the reverse repo balances, but Treasury in particular with the rundown of TGA helped lower the dollar from 114 to 104, took some stress off the Treasury market. That's buying some time. That's not sustainable for all that long. So my base case is something systemic breaks, probably in the first half of 2023, and the Fed, regardless of where inflation is at that moment, they've got to step in and resume QE despite that is what I think is going to happen. From SH, what is the lowest oil can go for any period of time before the whole system fails? And it's a really, I think it's a really good question. To me, the answer in short is the price of oil that takes U.S. shale production offline on the margin, right? So that price is probably $50 to $60 per barrel. Right now, U.S. shale is depleting. The big four basins are depleting at a 5.8% per month rate, right? So if oil falls to a price where you begin to lay down wells in the U.S., the marginal well, you're going to see, basically, if they stop growing, we're going to stop drilling for new oil. You're going to see U.S. shale production fall. Early days at 5.8% per month. That's a declining rate of decline. So it's not going to decline at 6% times 12 months, 72%. No, it's going to fall. It'll probably fall by a third, 25% to a third over the course of a full year. But what it implies is U.S. shale will never retake the 2019 peak again, at least not in any investable time horizon. And now you've got the oil supplies from U.S. shale, which have been 90% of global oil supply growth over the last 10 years, down 30%. Demand under anything other than a new Great Depression scenario isn't going to fall anywhere close to 30%. Not even close. I mean, that's Armageddon. That's, you get the shotguns and the spam and like zombie apocalypse. So it implies basically U.S. shale gets set aside as a defense of the dollar, as a political weapon. You get into a scenario where energy up, inflation up, growth down. Russia's got a lot more leverage. Central banks around the world have to sell treasuries aggressively to buy energy like we saw throughout this summer. Their currencies fall, rates up, dollar up, U.S. government interest expense surges until interest expense gets too big as a percent of receipts, which fall as rates rise nonlinear, kaboom. So I think $50 to $60 in oil is a really big number. But the key is the number where the incremental rigs start getting laid down, where U.S. shale says we're not going to produce anymore, and then you set off this dynamic of the depletion rate eating away at existing production. And it won't take too long for U.S. shale to decline at that rate, where the declines in U.S. shale production more than offset the decline in demand around the world. And again, the nature of shale is it's going to be very difficult to get back to 2019 if you stop, if that happens for years. Obviously, right, it's end of 2022. We haven't surpassed 2019. Still, we're up on the year. We're not up as much as a lot of people thought we would be at the beginning of the year. So with that, I'm going to finish up for today. As I mentioned at the start of the podcast, this will be the broadcast. This will be the last one of the bi-weekly updates for 2022. Thank you very much for all of your support and for listening in 2022. I look forward to talking to you in 2023. And as always, if you enjoy these updates, check out FFTT-treerings.com for more information about our tree rings product, 10 most interesting things, brief synopsis about what grabbed our attention about them, whether they are confirming or refuting a way we had previously been thinking about the world or the factor being described. So everybody have a very happy and safe holiday season. Happy New Year. We'll talk to you in 2023. Take care, everyone.